Ever found yourself staring at stock charts, reading endless market predictions, and still hesitating to invest? You're not alone. Many investors overanalyze every market moment, fearing losses and waiting for the perfect moment to invest. But here's the truth, there's no such thing as a perfect time. The longer you wait, the more opportunities you miss. The key to successful investing isn't obsessing over market trends, it's consistency and patience. That's where SIP, Systematic Investment Plan, and SMID, Small and Mid Cap Investing, comes in. Wouldn't it be great if you could invest without constantly worrying about market ups and downs? Well, let's dive into how you can do just that. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So how does SIP works? This is a foolproof plan for wealth creation. So basically, a systematic investment plan, SIP, is the easiest way to invest without stress. Instead of investing a lump sum, you invest a fixed amount regularly regardless of market conditions. Why is this important? You don't have to worry about whether the market is high or low. Over time, SIP helps you average out market fluctuations and ensures disciplined investing. So markets are volatile, but SIPs turn volatility into your advantage. Here's how. When markets fall, your SIP buys more units at lower prices. When markets rise, your SIP buys fewer units at higher prices. Over time, this strategy lowers your average investment cost and reduces risk. Example, let's say you invest 5,000 rupees per month in a mutual fund. Month 1, the NAV value is 50 rupees, so you get 100 units. Month 2, your NAV value is 40 rupees, so you get 125 units. Month 3, your NAV value is 45 rupees, which means you get 111 units. So without SIP, you might have invested at 50 rupees in a lump sum, but with SIP, your average cost per unit is lower, even if the market fluctuates. So investing should be easy, right? With automated SIPs, you avoid emotional investing driven by fear or greed, and you can stay consistent no matter the market condition, and you can also never miss an investment even if life gets busy. So why complicate what's already simple? Many investors panic when markets dip, but here's a question. Should a temporary loss matter if you're investing for the next 10 or 20 years? The answer is no. Markets have always recovered from crashes because compounding works best with time. Short-term noise shouldn't distract from long-term financial goals. This is why market timing is a myth. So some investors hesitate waiting for the perfect time to enter the market. But history shows that even experts fail at market timing. Example, if you miss the 10 best days in the market over 20 years, your overall returns could be 50% lower than someone who stayed invested. So is waiting really worth it? SMID refers to small and mid cap investing, a strategy for those looking beyond large cap stability to higher growth potential. So in small cap stocks, you get high risk but high reward companies in early growth stages. And in mid cap stocks, there is a balance between stability and aggressive growth. Here's a tabular column presented on the screen where you can understand the risk and rewards. So basically, it gives you the factors of small and mid cap funds, large cap funds, the differences between them. So between small and mid cap funds and large cap funds, what is the main difference? As you can see, if you have patience, wouldn't it make sense to allocate a portion of your investment portfolio to SMID funds? Let's say you invested a 10,000 rupee monthly SIP in a small or a mid cap fund. Here's what happens if you stay invested for the long run. As you can see on the tabular column, these are the SIP returns at 12% annual return. So imagine, like in 10 years it becomes 23.2 lakhs, in 15 years it becomes 50.5 lakhs, in 20 years it becomes near 1 crore, and in 25 years it becomes 1.89 crores, and in 30 years it becomes 3.53 crores. So imagine stopping your SIP after 5 years, you miss out on crores in potential gains. The lesson: staying invested beats trying to time the market. So many investors suffer from paralysis by analysis. They overthink and never take action. That's why there are common overthinking traps like: number one, fear of market volatility. Like, what if I lose money? Reality is short term dips don't matter in long term investing. Number two, waiting for the perfect entry point. I will invest when the market crashes. The reality is missing the best days in the market lowers your returns significantly. Number three, trying to time the market. Like, I will buy low and sell high. The reality is even professionals struggle with this. That's why SIPs work better over time. So, what is the ideal strategy? Which is balance and long term focus. Number one, set it and forget it with SIP. You can automate your investment so you don't second guess yourself, and you can benefit from rupee cost averaging and compounding growth over time. Number two, diversify across large, mid, and small caps. Large caps for stability, mid caps for a mix of growth and stability, small caps for aggressive long term gains. Focus on long term wealth, not daily fluctuations. The Sensex was 5,000 in the year 2000. Today it has crossed 76,000 plus. Despite crashes, long term investors have multiplied their wealth. Would you rather keep worrying about short term dips or enjoy long term gains? So, what is the final takeaway from this video? Investing doesn't have to be complicated. The best strategy is to start early, invest consistently, and to stay patient. SIP ensures regular investing while small and mid cap funds provide growth potential together. They create a powerful wealth building formula. Still unsure where to invest? A certified financial planner, a CFP, can help you design a strategy that aligns with your financial goals. So click the link in the description to book a free consultation with one of our CFPs today. Like, share, and subscribe for more such financial insights. See you in the next video. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.